Thank you for joining us at Black Roses Financial on our first season of Empowerment Through Financial Literacy. I am Sir Philip Anthony Rich, and I thank you for participating in our fifth episode, Pension or Annuity, where I explain what each is and the different strategies within each. I'm sure some of you out there remember when pensions were the main source of retirement income for most. So I'm sure you know what a pension is. But for explanation purposes, allow me to define each term first. What is a pension? After an individual worked for an employer for a certain amount of years, the employer would usually guarantee a salary after the individual retired, paying the individual in retirement after dedicated service to the company. This was a very common practice that has just been rare to find nowadays. Instead, they match 401k plans and they provide medical insurance. What is an annuity? An annuity is a contractual financial product that is designed to accept and grow funds from an individual and then pay out a stream of payments to the individual at a later point in time. The period of time when an annuity is being funded and before payments begin is referred to the accumulation phase. Once payments begin, the contract is now in the annuitization phase. Defined benefit pensions and Social Security are two examples of lifetime guaranteed annuities that pay retirees a steady cash flow until they pass. In the financial field, there are three main types of annuities, which may or may not have slight variations of each. Fixed interest annuities, indexed annuities, and variable annuities, and all have disadvantages and advantages. The first main advantage of any annuity is to have a bucket of money that is not tied to the market and still earning interest. The funds are increasing at a You are saving this money, the funds are being increased at a percentage and regardless of the market's performance. Furthermore, this investment can be annuitized and turned into a guaranteed income for the rest of a person's life. Annuities are tax-deferred financial products. So you will be taxed on your income from this financial product. Disadvantages of annuities is that your funds are usually heavily penalized if withdrawn earlier than the contractual agreement, making these funds illiquid or not easily able to turn into hard cash in hand. Certain products can work as a disadvantage to the customer due to the non-explanation of funds if the person receiving the annuity were to pass at a young age before he or she were able to use their money saved in this annuity. This disadvantage can be easily remedied, but annuities are sometimes looked at differently just because of this fact. So put clearly, individuals do not like annuities because they understand that the company that is offering this annuity will keep their hard-earned money if they do not use it all in retirement or the annuitization phase. In the past, this was true, but now there are remedies to make sure what is not used in the annuitization phase can be given to the beneficiaries of the person receiving that annuity. All annuities have the ability to distribute funds over a lifetime of 10, 20, or 30 years, or until death. First, let's look at fixed interest annuities, where, like all annuities, is a bucket where I can put money aside before tax and guarantee myself an income in my retirement years. My principal is protected, but the interest for these financial products is usually pretty low. When looking to accumulate as much funds as possible before retirement, these vehicles can be a bit slow in accomplishing this goal efficiently and effectively. These are great during the distribution or annuitization phase, during times where interest rates are higher and the fear of the rate decreasing being more likely in the future. Next, indexed annuities. Are annuities growing according to certain funds organized usually by industry sector and tracked by an index of how the investments in that sector are growing or declining. The set of funds or index can usually be changed annually within the company's different indices offered. Generally, fixed indexed annuities are low in fees, charges regardless of account performance. Others can have floors or minimums and caps or maximums on the amount one can earn or lose annually, and there are still others that have spreads. Spreads are charges once an account earns a certain amount. These accounts can also have a participation rate, which tells the investor or owner how much of his or her account is participating within the certain index. For example, a 75% participation rate means only 75% of the beginning principal or account balance is being credited for the index performance. Remember, funds are not participating in the stock market, so accounts are credited according to the index performance. Furthermore, fixed index annuities also have an added bonus of principal protection, which means these companies can guarantee the amount originally deposited back to the client regardless of index performance. How are companies able to do this? Insurance companies partnering with banks like Nationwide and JP Morgan and an insurance company called Athene and Merrill Lynch, where the insurance companies grow well in a low market and the bank secures the funds while giving great growth in an improving market. These are just a few opportunities available. There are many others with minor details that can mean a big difference in determining which one works well for your personal portfolio. For instance, many have a free withdrawal amount. So here, how much liquidity depends on each company's strategy. This is where finding what is right for you makes sense talking to a financial professional. Finally, variable annuities usually have high fees associated to them and are tied to the market and have the opportunity for great growth potential and market outperformance, but also have the potential of earning less capital accumulation during a market underperformance. This means a smaller income stream if this were to come to fruition. However, a simple policy writer can solve this problem as well. The minimum rate of return rider, which will be called something different from one company to another, is what would work well in this situation. This strategy can make sense in certain situations where time is on the client's side and the market volatility will not make a big difference in the end. Understanding what makes sense for your retirement portfolio requires looking at your full financial picture and viewing it from a mile-high viewpoint. Once we know what makes sense, the details of each strategy must be carefully reviewed to obtain the necessary liquidity while still obtaining great growth for the account. My information is on the screen, and if you go to my website, you can fill out a form and set an appointment through my website. Or you can call or email to set up an appointment as well. Let's take time to set a free consultation to meet in one of my offices so that you may ask the questions that you need to learn more about Black Roses Financial so that we may help you. Remember, I have many offices near you in the Washington, D.C. area, so let's find an office that works well for you. Thank you for joining me, Sir Philip Anthony Rich, with Black Roses Financial on empowerment through financial literacy. This is episode 5, Pension or Annuity. Please be sure to join us next week on episode 6, Term or Perm, where we discuss life insurance, the different types, and the advantages and disadvantages of each. Till then, thank you. Cheers.